Hi, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. We're so excited you are here. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and, however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions and make comments in the chat box. The presenter will address those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to address it, go ahead and leave your contact information as well, and we'll make sure someone reaches out to you after today's event. We want this educational event to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. And I'm just going to go ahead and turn on the chat for our attendees. Very good. Well, I'd love to introduce you to our presenter today. J.R. Guerrieri is a certified financial planning practitioner that utilizes a unique approach and methodology called financial life planning. Life planning connects the dots between our financial realities and the lives we long to live. This method is based on the premise that advisors should first discover a client's most essential goals in life before formulating a financial plan, so a client's finances fully support these goals. As a lifelong learner, musician, and athlete, JR holds a black belt in Brazilian Jiu-Jitsu, trains Muay Thai, and has been playing the guitar for over 30 years. He actively performs and writes music in his band. And JR, I'm going to turn the time over to you.
Wonderful. Okay. Marcia, actually, I'd love for you to participate today because you're so knowledgeable on the subject.
Well, let's just say we've gone down the rabbit hole a little bit preparing for this. And I'm happy to make some comments just from my research, but I will preface this by saying I am not a investment advisor, and this is just someone who is maybe a market nerd.
There you go.
There you go.
There you go. So Marcia and I came up with the idea of talking about the recent banking crisis and just give the general consumer a perspective on what happened, and so you could walk away with a little bit more knowledge than you had before. We're going to give you some facts, we're going to give you some figures, but I'm also going to give you my opinion and talk about some of the things that we did our homework on, both Marcia and I, and we were discussing before the meeting, some of the things we found, and advise you to do your own homework and learn about the banking system. As Marcia said, I'm a financial professional in the world of giving advice on growing your money and doing the right thing to reach your financial goals and everything that comes along with that. And one of the advice I give people is to make sure they put money in banks, because we want to have a good, strong, what I would say, a cash position. And I often give the advice that you see right here on the screen. I am not a banker. So one of the things that we would, I just have to let people know is I'm not a banking, expert. Right. But I understand the system because I have to operate in it and give advice about it. And so one of the things that I teach people is when you go deposit money into a bank, if you have a checking account or a savings account and you deposit $250,000, that's all you deposit. Okay, because that is what your money is insured. So insured means that if the bank fails, the United States government steps in and makes you whole on your $250,000, not one penny more, generally speaking. And the way they make this rule is, as it says there in the second bullet point, per depositor, per bank, per ownership category. Okay, and so the name of this insurance that protects your money and your deposit is called the FDIC, Federal Deposit Insurance Corporation. So all banks sort of like throw on their window or on their website that they are FDIC insured. If you see that, you should feel good about it. Generally speaking, this is what you want to understand. If you have more than $250,000 to deposit into a bank, for whatever the reason is, you would want to start thinking about how you allocate those dollars. So what you wouldn't want to do is put all, let's say you had 500,000 into one account. That would not be smart. That would be foolish, because if the bank went under, then what could happen is you're out $250,000 if that bank goes under. Okay, so what you would want to do is set up another account inside the bank. Now that other account would have to be something else, right? So a good example would be like a CD and your checking account. You can use a trust and a checking account. You can use an IRA and a checking account, right? So everything has its own 250. Now, if you're married and you have a spouse and you both have a checking account, like a joint account, both of you insured up to 250, therefore $500,000 of the family's money is protected. Okay. Now, one of the things that I'm going to throw my opinion on is, if you're going to have that much money in a bank account, okay, might want to consider diversifying your banks, right? And so instead of just putting all 500,000 or 750,000 into one bank in different ownership categories, then you put it in different banks, so you'll feel a little bit more. It's just the concept of diversification. Don't put all your eggs in one basket. So that's the basic principle there.
All
Go to the
right.
next slide.
Yeah. And
Okay.
also, JR, if there's a particular point you want me to chime in on, just let me know. I was going to bring up, what about taking it to other banks? Actually, I do have a question here. So, 250K is a large amount of cash for any single person, typically. Just in the back of my mind, I'm thinking, why would you have that much cash in a bank anyway? My thought is, you're putting that money to work for you, and investments and other sorts of, things that would grow. Talk a little bit about that.
Okay, so the first thing is emergency savings. Okay, emergency savings, generally, if you did a quick little research or like a Google search or something, you're going to find the answer to that question is 3 to 6 months of your basic living expenses need to reside in a checking, savings, CD, money market, savings bond type that you would get at a bank, right? These are the accounts we get at banks. And that's not bad advice at all, right? And so if my bills were $5,000 a month, well, what are bills? Your mortgage, the basic insurances of your life, your like, car insurance and homeowners insurance, your food, your car. I mean, if that stuff is equaling about $5,000 on my little math there real quick, right? 3 to 6 months, right? You would want between $15,000 and $30,000 sitting in a checking savings account at all times. So, like I said, not bad advice. There's another perspective that I teach people. This is not like, there's no like rule sent from the heavens on this one, but like I'm looking at it from a different perspective. If you're making $100,000 a year, right, then I want 6 months of your annual salary sitting in checking and savings, which is a much bigger number, right? And so what's half of your annual salary? If you're making $100,000, you would want $50,000, okay? If you're making $200,000 as a family, I'd want $100,000. If you're making $300,000 as a family, I want $150,000. Okay, now why? Why such large numbers when, yes, Marche, you should be putting those dollars somewhere else to work for you? Well, first of all, when you have that much cash, that's great for emergencies. you'll feel a lot more confident about putting money in things that are aggressively allocated and do that up and down. And then, of course, so opportunities is another reason why I want people to take advantage of business opportunities when they're presented. And business opportunities are being presented to everyone in our society all the time. If you have the cash there, you can participate. Okay, if you don't have the cash there, you can't participate. So great opportunities, even though they were horrible events, were like 2007 to 2009's crash in the stock market, right? Or real estate was very desirable then, believe it or not, if you had cash. Same thing with COVID. COVID offered us some real opportunities in both stocks and real estate as well for a very short window. It was a very short window. But if you have that much money there, you get to participate in the opportunity. If you don't, it also helps keeping you from borrowing money. Borrowing money sometimes is good, sometimes it's not. And if you borrow money, you have to pay interest, and that's sort of like an eroding factor. So those are the reasons why I want so much money in an account. And the ways you get there are, it's a topic of another conversation, but that's how I feel about that. And anything in between, right? So like 3 to 6 months of your basic living expense, half of your annual salary, and somewhere you can flow in and out of that. And another thing that's really interesting about that concept of half of your annual salary, most people live off of half of their annual salary every year, right? Because think about it, right? Like if I'm making 100 grand and I got to pay, 30% in taxes, 40% in taxes, whatever it is, then you got your retirement plans, and then you got your health care, and next thing you know, if you take everything away, your basic living expense is half of your annual salary, right? And so what does that mean? If something went wrong in your life, you have a whole year to get back on track, right? If you have that much, right, to live off of your savings account while you get back on track. And what are the things that can happen? Change a career, right? Something bad can happen in your family life. And so, as an advisor, I'm thinking about every angle, right, for a person. And that's why I'd say such large sums of money should be there. So, we have to look at this.
We did have a couple questions get in, but one just goes right into this. So what happens when a bank fails? Well, we can cover that. And then we had another question about investment protection. So I think maybe we'll hold that one to the end.
Okay. So what you're seeing is the answer to the question is literally written out word for word from this is right from the FDIC website. And so if you just read that, they just come in and step in and make you whole. I mean, it's that simple. Like you just go to your bank and get the money out and you're good to go. I mean, so that's what happens. Does that answer that question?
Yeah. And so does that include CDs? That was the question there.
Yes, it does. Yeah.
Okay.
Okay, Silicon Bank failed. All right. So a lot of people heard about this. So let's talk about, let's just real quick, before we go into what happened there, we have to talk about how our banking system operates. So the first thing we want to understand is that me and Marche are the only two customers at a bank.
Okay.
And both of us deposit $500,000 each into the bank. And how much money does the bank now have in their vault? Easy math, we have $1 million even in the bank vault. Okay, now how does a bank make money? Okay, they don't make money with your checking and savings account. I mean, they get some fees every once in a while, but like generally speaking, that's where the money is. The way a bank makes money is they lend it. Okay, so they lend money to the rest of so they do mortgages, they do credit cards, they do personal loans, they do, what else am I thinking? Car loans, business loans to like small businesses, right? So the process of lending money out to people is the way they make money. So it's actually not the lending of the money that they get, it's the interest that they charge people when they receive the money back, right? And so they're receiving dollars from you, and that receiving of dollars pays them their profit. Now, it's kind of interesting. Now, I'm going to make up numbers here and they're not real, but like, for instance, a lot of people have gotten a mortgage before. And if you've ever seen a mortgage, okay, what happens is it's called a, let's just think of it like this. If I have a $500,000 mortgage and I'm paying, $1,000 a month for my mortgage, I'm just making up numbers. What people don't understand is, is when they receive the $1,000 from you in your payment, how much of it is what you owe and how much of it is their profit. And so this is called amortization. If you look at an amortization table, what you'll find out is of your $1,000 that you sent in, like $900 is their profit and only $100 is your principal coming down. So if you wanted to pay it off and you paid $1,000, no, you didn't reduce it by 1,000, you only reduced it by $100. So that's how banks make money, is they collect their profit earlier on in the process. And then as later on goes by, that you've paid off the loan itself. Okay, so that's how banks make money, right? It's the process of lending and they receive dollars. Okay, so how do they make more money? The only way they can make more money is do more loans, right? So they have to keep lending and lending and lending and lending and lending. Okay, so where do they get the money from? Well, me and Marche, right? We put the $1 million in there. And so how much money do they have in their vault to lend? Well, anybody would just go, well, if they only have $1 million in their vault, they could probably only lend out, I don't know, something in $1 million or less. Wrong answer. That is where we come to the definition of fractional reserve banking. A bank is allowed to lend out more money than is actually in their vault. Now, and they have to guarantee that the people inside of their vault get their money back when they need it. Okay, so this is where things get a little weird. So fractional reserve says this: a bank doesn't need to have all of the money in their vault in order to lend out money. They can lend out more. That is the basis of how our banking system works. Okay, so this is where it gets a little interesting. Some people will go, is that a good thing or a bad thing? Well, actually, it's both. Okay, so the reason why it's a good thing is because if banks had to have 100% of their dollars inside of a vault that they lend out, well, then our economy would move like a snail. Okay, it would not grow rapidly because the way society grows, interestingly enough, is businesses need to borrow money that they don't have in order to bolster their business, whether it's marketing dollars, building warehouses, research and development, and they need these dollars, right, to come up with ideas and creativity and innovation to generate a business and make more money for themselves, right? That's how businesses grow. They have to get capital, right? So if banks weren't able to lend out, if they were limited to the amount of money that they can lend out to what's just sitting in their vault, there'd be less loans given out to businesses and then less growth. And remember, this is like a thing that goes on. Thousands and millions of people across this country are doing this all day long, right? So if you say to the bank, hey, you can lend out more than you have in your vault, well, now you start to create growth. And that's why, the United States works so well, is because we have this like very, very growth-oriented, creativity, innovation-minded economy. So that's a good thing. So they can lend out more than actually theirs. They're actually like creating money in thin air if you really think about it. But that's an opinion. Anyway. Okay. But why is it bad? Well, what happens is if the customers all decided at the same time to take out their money, but the money's lent out somewhere else, now you got a problem, right? So they don't have any money to give to the people that said that this safe money is there. And we call this concept a bank run, right? When people come and take their money out. And so the way sort of like the banks do it is like they lend your money out, but they take money from someone else's account to give you back your money, right? And it just keeps going on and over. And they can kind of like keep this thing in check. But when a large sum of people come out at once and take out large sums of money, they have to get it from somewhere else. And usually it's these other people, right? But if the other people are taking their money out, now you got a problem. All right, so let's go back to, so that's fractional reserve
banking.
Banking. Okay. So it gets a little weird. So
It is a little complicated. It's
a little
not,
complicated because
yeah.
go ahead if you want
No,
to add something.
I was just going to say it's definitely something that it goes against what maybe we would learn in elementary school about banks and about this kind of simple concepts. However, that's what most economies in the world have
Most. Yes, most.
this is the system.
So
Let's talk about Silicon Valley Bank now.
yeah, I was going to go into how much they have to bid. Let's just first do this. So okay. So Silicon Valley, here's what they did. So they're very well known for their startups in the tech area. They're from Silicon Valley, where most tech startups are. And so they give out a lot of loans to new companies, which is great for bolstering business. And they had a ton of hedge funds and private equity companies that were sort of banking with them as well. A very successful bank. Okay, now, people have deposits there. So they were lending money out, but they also did something called buy United States bonds. Okay, now, bonds is where things get a little tricky, right? We're talking about government-backed bonds, which are typically very safe financial products. So the bank was utilizing safe financial products, okay? So the only risk of a bond has nothing to do with the government. It has to do with time. So the longer I have a bond, so bonds are sold in duration. It's a time frame. Like I can have a 6 month, 1 year, 3 years, 5 years, 20 years, 30 years, right? And so I purchase this bond from the government, and every year they pay me interest or profit. And so the bank is making profit by just holding dollars in bonds, right? And as the bonds, what we call mature, they get their money back and they give it to who they need to give it to in their vault. Okay, so sometimes they're buying and selling bonds all the time. Okay, now the way to make the most money is to have long-term bonds, long-term 30-year bons.
In general.
Right.
Yes,
in general, right? It's a little
right.
bit, that's another caveat.
Yeah.
So generally speaking, the longer term bonds pay the most because you have to take on what we call interest rate risk. The risk that the interest rates move on you while you're holding a bond for a longer period of time. So you get paid the most. Okay. Now, when you hold a bond to maturity, you get every cent back, every cent by contract with the US government. So they have to give you your money back. So that's safe, right? If I hold the damn thing as long as I need to, I get my money back. All right. And so it gets a little tricky when you need your money before the maturity date. Okay. So if you need the money before the maturity date, okay, and let's say a bond's paying 2%, right? The one that you bought, and halfway through the term, new bonds are paying more, like 3%. Well, wouldn't you want the new bond paying 3%? Yeah. Why would you buy someone who's got a 2%? So the only way the person who's carrying the 2% bond can entice you to buy it from them, if you need to get out early and get your money, right? You have to lower your price. Okay, so the price of the bond or the value of the bond goes down. Okay, so this bank, go ahead.
Yeah, I was just going to say, and you are not able to get it from the bond issuer. You have to sell it on a secondary market, correct?
Secondary market. So if you say that I need my money back before the time, or what we call maturity, when it ends, okay, then you are not dealing with that entity anymore. You have to sell it to somebody else on this planet. And plenty of people will be willing to buy it from you, so you don't have to worry, but they may not give you for the full dollar amount. Okay, so Silicon Valley a long time ago buys 30-year bonds, not making much money, close to zero, by the way, near zero, okay? And so when you're near zero, which way do you think bonds might go in the future? Well, you can't go below zero. I mean, you could, and that's another topic in our conversation, but generally speaking, you're going to go up, right? But they were like, who cares? We're making as much money as we can, and everything's fine. Everything's just our business is flowing. We're getting new customers all the time. We're doing good. We're doing charity work. Like everything's wonderful. Okay. so but all of a sudden, out of nowhere, this last year, what happened? We had inflation. And the way to stop inflation is the government, the Fed, raises interest rates. So rates went up, which means all the value of people's old bonds are going down. Okay. But the bank didn't care. Why didn't the bank care? Well, because they're going to hold them for 30 years, right? They're making their interest, they're making their money. The only thing that could have happened that could cause the problem happened. And there was a bank run. There was a run on the bank. Now, there's some fun stories in the news of why that happened. And I've heard all kinds of crazy stories, but here's what happened. A bunch of people that had money at the bank in deposit, right, in the vault, said, give me my money. And so they take their money, okay, and the only way to generate the cash needed to give back to the people is they had to sell their bonds early. The bank sold their bonds early at a loss, okay, to make these people whole. Yeah, but then all of a sudden the news got wind of it, or, you know, the airwaves, and then everyone started taking their money out. And so they had to keep every dollar they had invested in bonds, kept losing and losing and losing and losing, eventually to the point where there's no money left. That's what happened. And then it also happened to other banks, same thing. And so that's Silvergate, Signature Bank, and it's the same thing. You are starting to see that mismanagement of risk. You have leadership who are, this is my opinion, right? You're not managing your risk. You're not doing your job. The problem is we are a profit-driven society, right? And sometimes we focus more on the profitability to make our shareholders happy than really managing the true risk, which is already, it's happened in our lives. So it's not like I'm pointing out something that people don't understand, right? This happened in 2007 to 2009 in the banking crisis and in the real estate crisis. We manage our profit and don't manage our risk, right? And so then rules are created in our society to prevent these things from happening. 2007, 2009, they made some banking rules to make sure that banks never got into the situation that they did. Only 20 years later, I mean, this is like yesterday. I remember being there in society, like watching this happen. And then all of a sudden, the banking regulations to protect us from this happening got what? Moved to zero. Almost no regulation. Almost is a key word, almost. And me and Marche were talking about this before. What does that mean? And so they don't, there's no federal mandate of having any reserves in your bank right now. I mean, like they could just keep loaning out money. Now, from what me and Marche were discussing is it's not just that simple. You can't just like, you know, it's not like a Wild West, if you will. It has a lot to do with like the size of your bank. It has something to do with like how profitable you are already. If you're very profitable, it's like they're a little bit more lenient than not profitable. But yeah, I mean, this is the world we're living in. And so, I think the moral of the story is this. Your finances is your responsibility. It's not the government's, it's nobody else's, okay? You have to do your homework, right? You have to talk to people. You have to bring in professionals. You have to bring in expertise. One of the things I teach people about being a financial planner is somebody has to manage all the experts you have in your life. You need CPAs. You need lawyers. You need insurance people. You need all the real estate professionals, right? You need these people in your lives to get their expert opinion on things, even from your banking system, right? And so I want people to understand, you can go to the local bank that, nobody outside of your local community has ever heard of, right? Joe Schmo Bank, right? John Smith Bank, Susie Smith Bank. Go there, meet the people. I bet you walk in the front door and you'll find that there's a picture of like the Little League team there, right? And there's a picture of like the pizza restaurant. And like they're all working in a community, and you can walk in, get the financials of the company, meet the owners and the CEOs, and get a relationship going and discover, is there trust? This is my opinion, Marche. I recommend doing that. Like I do business with my local institutions, okay? Nothing wrong with big, giant financial institutions at all, right? But we've seen what happened with big, giant financial institutions. they fail, right? I mean, it's not that a small bank can't fail, of course they can, but so far in society, we have a government that steps in and fixes and comes to bat. And you've heard like we were talking about the concept of too big to fail, right? If you let something like that fail, it just causes so much havoc that they don't even want them to do it. And so our tax dollars usually is there to support these institutions. So it just doesn't ruin everyone's life, which is another topic of, it's definitely a topic that people like want to fight about, right? And argue about, right? How much government play should there be and taxes and so on. But yeah, so I think I covered everything on the slides. Yeah.
Yeah.
And so this is,
this kind of rounded it out, and then we're going to take questions. We've got quite a few questions about some terms, so maybe we can take some questions. Let me see.
And it says right there on your bank, know
Yeah.
your bank. Did you see that? That's really important. Know your bank, diversify.
Yeah, I think we've already covered that. All right. So can you talk about kind of what some of these entities are? So what is a CD, and after that, what is a money market account? Those categories people are asking about those.
All right, give me 1 second with that. I'll give you guys the
official definition.
Official definition. Just give me 1 second. So a CD, okay, are safe, interest-sensitive agreements between you and a bank wherein you deposit funds in the bank for a designated period of time in exchange for a return of interest. These are typically insured up to FDIC. Okay, so it's that simple. I mean, I know that was a lot of jargon, but yeah, I mean, it's just another investment tool. They take your money, they lend it out, and you have money there, and usually interest rates higher than your typical checking or savings account. What's happening is they're putting rules on the dollars. Okay, so like your checking account is known to what? In and out, in and out, in and out, in and out, right? So it's hard for them to do their banking on your in and out, in and out, in and out. Whereas a CD is typically a larger sum of money that's static. They know it's going to be there, so they provide you with a higher, more interest because they know it's a static dollar. I mean, I'm just talking like big picture.
Yeah, I think the big picture is, they had a question about like what happens to your investments if a bank fails. I know that the research I've done that typically the FDIC creates a bridge bank, and then which is kind of an intermediate entity, and the bridge bank administers, all of the accounts until that bridge bank is sold to another entity, typically another bank. So they were asking specific about terms about what happens to your CD if your bank failed. I would refer them to that particular bridge bank, and I'm not sure exactly. You need to refer to your own specific situation how that happens, but my understanding is that they're trying to keep it as seamless as possible for customers. They don't want to cause more financial problems.
Yes, exactly.
Yeah.
But just want people to know that with investment accounts, you're not insured with the investments up and down. Did we talk about that? The ebbs and flows?
No, we haven't. That was one I wanted to talk about, but it's not the same entity as a bank. Like a brokerage is not the same thing.
Correct. Great. So
let's talk about that. Let's talk about if you have stocks and bonds invested at a brokerage with your financial advisor with some sort of custodian. Talk about that.
Yeah. So what happens is essentially, if you lose money by the advisor's opinion or your own opinion, you're out the money. Nobody's helping you. No one's coming to save you on that. Okay. So these ebbs and flows. But if the institution itself fails, okay, your money is insured 100%. Meaning your stock value doesn't just disappear because the institution itself failed. So it's insured from that perspective.
I believe it's insured up to the 250K. I think it's a different entity. I think I was looking it up just a minute ago. The SIPC is what
Yes.
insures those entities. So it's similar to the FDIC, but it's a little different because of the market fluctuation so much, it doesn't protect you against the ups and downs of the market. But if the institution itself fails, then you would be insured up to the amount that the SIPC insures that amount.
Good. There you go.
I believe so, but again, this is just coming from a market nerd. I can give you it's sipc.org and you can look that up yourself. All right, here's another question. Can you explain what a money market account is? This person is international, so they don't actually know what that's not very common in their country.
It's just another type of savings account offered by banks and credit unions. It's just similar to a regular savings account, higher interest. They have minimum balance requirements, and they definitely have a limited number of withdrawals per month. So, and it's just like another savings account. And you can get into the weeds on these things, like what actually is happening, but for the most part, yeah, they are. That's how they operate. Most so this is probably important to understand is when you set up an investment account, okay, like where you're going to buy stocks and bonds, what happens is you have your personal checking or savings account, you wire the money into your investment account. Now it's sitting at this investment firm, right? The big, what you call broker dealers, right? Or custodian. And what happens is they leave your money in a money market account until you actually buy or sell anything, right? So you buy something, the money from the cash of the money market account, they go buy, Apple stock, Google stock, or whatever, right? Or the bonds that you buy. And then let's just say you earn dividends or you receive interest. What actually goes and sits in the money market account inside your investment account. So money markets are used a lot with your investment account.
And that's typically kind of behind the scenes. I'm assuming because I've never seen that like on my statement.
Yeah, you'll see it. You'll see like, oh, money market or something. Yeah.
Okay. All right. That's interesting. Are there research websites that rank or assess how risky a bank or credit union is?
Yes. There's a ton of rating agencies out there. I believe actually Moody's was the one who I heard that it was from Moody's that was the first one to sort of like put out there, hey, this bank doesn't look that good with SVB Bank. So Moody's is one of those rating agencies.
Very interesting. Okay. So this is just a very broad question. Maybe you can talk about investing your money and where, let's say you've got all your money in the bank and you now realize that maybe I should diversify. So can you talk about the different options for putting money other places?
Sure. So we want to come with a baseline, a dollar amount that needs to be in savings and checking and CDs all the time, right? We want a baseline, right? The 3 to 6 month rule of your basic living expenses, or the 6 month rule of your annual income, somewhere in that range. Once you have that achieved, okay, you should feel what I would call safe, right? And from there, what I would start to do is if you have too much money in an account and you're above that amount, then let's start thinking about other investment vehicles, right? There's stocks, there's bonds, there's investment accounts, there's insurance products that generate wealth for people. So these are all great tools. I mean, buying real estate is another thing, right? Starting your own business is another tool. So these where you want to start thinking about putting your money into these kinds of things. Is that kind of the answer, or is she talking about, or he talking about like how do you just get it out of the bank and move to another bank? Is that what you mean?
No, I think they were looking for, where should you put your money if not
retirement
in banks?
accounts.
Yeah.
Yep.
And that's definitely a reason to talk to a financial advisor. If you've been saving and you have a big pile of money and you don't know what to do with it, that's what financial advisors do, is they help you put it in the diversified places to grow it and keep it ready for you to retire and not have to rely on a big bank account, right?
Well, I mean, you can't leave your money in a bank account because you're going to run out of money. See, there's a concept called inflation, right? And every year our products and services in our society, they cost more and more. They go up more and more. Your bank account won't keep pace of that. It just won't, right? And so at some point, you need those dollars to start working for you and growing, right? And so, growth-oriented financial products will hopefully, typically, stay ahead of the drag of the inflation that's going on in our society all the time. So you have to get those money out of there. I mean, it's just, you're going to erode your wealth away if you just leave it in those kinds of accounts. You have to get them out of there. Yeah. But safely too. Like, I'm not a big fan of being this just wild, chaotic investor, right? It's not about the stock market. It's a coordinated, well thought out strategic effort. So, yeah.
Yeah. All right. This is a kind of a wild card. I have never heard of this. So I might have to just refer them to do some research on their own. A reverse repurchase agreement. Have you heard of that between banks?
No, I'm not familiar with that. That'd
All
be
right.
probably a banking professional for that.
Okay.
Reverse
Can you
repurchase?
now you gave us
Now-
more
now-
information to go down another rabbit hole. So unfortunately, we're not experts on that. All right, well, we're gonna go ahead and wrap things up here. We might have had a couple questions we weren't able to get to, and I will reach out to you, or I'll have a member of our team reach out if we were not able to get to your question. And I want to thank everyone for being here, and want to thank JR for chiming in on this important subject today. And look to your email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.